Money Show.
Personal Finance with Warren Ingram.
22 minutes to 8 o'clock now. Personal finance and how to protect yourself from panic when markets drop. Our guest, of course, is Warren Ingram. He's a personal financial advisor and also the executive director at Galileo Capital. Hi, Warren. Good evening. Good to chat to you again.
Thanks so much, Ray. It feels like it's you and me on the show every Thursday nowadays. I think, Bruce gallivanting around the world.
Yeah, what's that about? He just cracks the nod to Davos, and you and I sit here and discuss the world's problems. It should be the other way around.
I must say I'm feeling rather left out.
Oh, that's all right. We just won't share with him when he gets back. But one thing we will share is knowledge on how to protect yourself from panic when markets drop. And this is the big thing because markets are very volatile. I was looking at the All Share today. Lovely. It's back. It's up because the US Fed is a little bit cautious now on interest rates. But tomorrow they may say, you know what, we're going to slash their rate by, say, 1 percentage point or something. And then we follow suit, and then the markets drop, and it all goes to hell. What should you do not to panic?
Well, I'm glad that you're quoting the US Fed, because I think it's, at the moment, a lot of what's going on with the JSE is dictated by global events, and to a large extent, global events are dictated by what happens in the US. So, focusing on what the US market does will give us a really good indication of what's going to happen to us. And I think the first thing is when markets fall, it's really key to have a context to what's going on. Why are markets falling? You might not know exactly, but if you get a good sense that this is, really a global event, it's not unique to South Africa, maybe not even unique to emerging markets. It's something that's being driven globally. It's important to get a sense of, are we in kind of a spring tide? Is this kind of like one of those major once in a 200-year events? Because once you've got some kind of context to how big the fall is and potentially how much pain you're going to go through, you also have a sense of what recovery will look like. So I thought it was interesting just to give you an idea, Ray, of what happens to the US market when it falls. And, important to kind of just remember that the US market falls by about 10% every 2 years. So kind of every second year, the US market has a drop of 10%. When that happens, you and I will be talking about quite a big drop in the markets, and investors are losing out. They're getting a little bit fearful, etc. Because 10% is a big number. You've got R1 million invested. So suddenly, you see it sitting at 900,000 rand. It's a number that will scare a lot of people. But that's not where we are. Where we are now is that the US market is, as you say, depending on the day, it's probably down about 20%. Now, the US market falls by about 30% every 4 to 5 years. So when we talk about the long term in stock markets, we generally will talk about a time frame of kind of 5 to 8 years. So what you would say to someone in that situation is, if I tell you, I think you will make very good returns from the stock market as a whole over a 5 to 8 year period, implicit in that is that you are going to experience a loss of 30% in one of those years out of the next 5 to 8 years, and maybe even 2 drops of 30% over an 8-year period. And I'm crazy enough to tell you that will still be, you'll still get the good returns of investing in the stock market. So I think it's important to say, I'm not predicting how much the US market's going to fall and therefore how much it's going to drop the JSE. What I'm saying is a fall of 20% is normal. This happens every few years. And if that's normal, then this is by no means the end of the world. No matter what we're reading in the media, no matter what the talking heads are saying, we've seen this kind of a movie many, many, many times before, and therefore we know what happens. What will happen is when the kind of prognosticators out there, especially fund managers and investment strategists and economists start saying, almost universally start saying, we expect major recession. We expect that this could be a multi-decade low. And, investors should really not expect any kind of growth from their investments for the next 10, 15 years. When they're all universally gloomy, you should start to spar. You should start to say to yourself, this stage of market collapse even has a name. It happens so often it's got a name.
Yeah.
It's called capitulation, right?
Okay.
And I don't think we're there yet. People haven't kind of given up completely on investing as a whole, but they are starting to get increasingly panicky and more people getting more and more gloomy. And for me, I'm watching this and I'm saying to myself, okay, I think we're getting close. We're getting close to capitulation point. As an investor, if I'm looking at this, I take the view to zoom out. I don't look at what's going to happen tomorrow. I don't look at what's going to happen in 2 or 3 weeks' time, because the reality is neither you nor I nor anybody in Davos knows exactly what's going to happen in the next few hours or few days or few weeks. We can speculate, but we don't actually know. So it's important to zoom out and say, what's going to happen over 5 years from now? What's going to happen over 10 years from now? The money I'm investing, can I afford to leave it invested for that long period of time? Because if I can, what I should be doing is I should be taking any cash I've got, feeding it into the investment markets over the next sort of 3 to 6 months, and buy the shares, especially quality shares, quality indices that everyone else is selling now because they're panicking. And I'm going to make good money out of their panic. I would hope they don't panic, but unfortunately, they panic so regularly that we give it a name, a capitulation. Don't forget. So sorry, Ray?
No, I was saying, I'm listening to you. This is just very interesting, capitulation. But then, okay, so what happens next? Because this is going down, 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 and what goes down has to come up.
Exactly right. So what we're experiencing is the reestablishment of financial gravity. And to me, financial gravity looks like inflation, that we have some form of inflation around the world, and more especially, more critically, that we see that places like the US, especially Europe, actually charge interest to people who need to borrow money, and those that can store money on deposit, that they actually earn interest. Because surprise, surprise, that really hasn't been the case, at least since the year 2008, and certainly for most professional investors in the US or in Europe, they don't even know what inflation looks like unless they're older than 45. So we're in an environment now where South African investors are looking at this and saying, gee, we understand this incredibly well. We know what inflation is. We know what it is to pay high levels of interest on debt, and we know what it is to earn interest on debt. So now that financial gravity is reestablishing itself, it's important to take your point, Ray, which is if things go up forever, they'll come down. And equally, if things go down for a period of time, they'll turn and start going up again. So to answer your question, I hate to waffle, but to answer your question, I think we see markets staying low for a while. I don't know what a while is, maybe till the end of the year.
Yeah.
And once investors around the world have got a grip on what inflation looks like in the US and in Europe, then they'll know what the central banks are going to do. At some point, the Fed will stop raising interest rates, and I think maybe the markets got a little bit excited, today, and Americans, last night and today again, thinking that they know that maybe inflation isn't going to be as scary as they thought, and therefore interest rates won't go up as much as they thought. Who knows what happens tomorrow? But once the markets get a grip on this, then they'll start to price in a recovery. They'll start to price in that the world's not going to end, and surprise, surprise, business will carry on and things will go up again. And by then, once they start to do that, you need to be fully invested, because markets will recover really quickly. And sitting on the sidelines and waiting for the news headlines to get better and for the prognosticators to tell us that the world's turned and everything's going to be rosy and sunny again, by the time that happens, the savvy investors who've been invested have started to make good money again. And I think that's the cycle you want to break if you're an investor. You don't want to be part of this herd behavior that continuously repeats the same mistakes, market cycle after market cycle. You can't be part of that name, the recovery after the capitulation. It's just silly to kind of keep falling prey to that emotional response. I'm not saying I don't understand it. It's human nature to be emotional when you see, your R1,000,000 suddenly becomes 700,000 Rand, and there's some guy on the radio who says, don't worry about it, everything's going to be great. I appreciate the emotion attached to this, but the point is, humans are individually rather intelligent, but the moment you put lots and lots of human beings together in bigger and bigger crowds, unfortunately, they become less and less intelligent as a collective.
You see,
and the biggest collective are investment markets.
You see, it's because we get into that herd mentality, and that's the big problem. Right, our guest tonight, Warren Ingram, our personal financial advisor, also executive director at Galileo Capital. I want to chat to Warren shortly. You can take a break now, but shortly about what happens if, say, for instance, the Fed gets it wrong.
The Money Show.
Personal Finance with Warren Ingram.
Right, Warren, talking about how to protect yourself from panic when the markets drop. But what happens if the Fed goes up and goes down? And they do this sometimes. 1 minute you have Jerome Powell saying, oh, you know what, hold on a second, interest rates we need to increase them. And then all of a sudden today you go, well, maybe not. Doesn't this get a little bit of higgledy-piggledy? You don't quite know what you're doing.
I hope they know what they're doing, Ray, because I think, the real concern they have is this beast called inflation, and inflation is like that snowball that goes down the hill. It's very hard to stop once it gets a certain size and a certain momentum. So the danger will be that they increase interest rates too fast in their attempt to control inflation. What they end up doing is putting the whole U.S. economy into recession, and then you get the situation where you might have rising prices. In other words, high inflation, more people losing their jobs, and companies struggling to grow. It is a possibility. I think that it's important to remember the U.S. central bank, the U.S. Fed, has a dual mandate, which makes them very rare in the world of central banks. For example, in South Africa, the central bank here only focuses on inflation. But the U.S. central bankers, they have two mandates. They must focus on inflation and they must focus on employment in the U.S. So they will be also very careful not to take such drastic action controlling inflation that they suddenly cause employment to start declining. In other words, unemployment to start rising. So it's impossible to be, perfect and accurate with these things. But I think that they're so careful at the moment of forecasting far ahead as to what they're thinking, how they want to raise interest rates, that they're trying their best not to shock the market in any way and to give the market as much time as possible to absorb the news of rising rates and therefore, allow the market to make sort of more rational decisions because they've got more time. But I think if the Fed gets to a situation where they realize inflation has turned the corner, in other words, it's starting to go down and it's going down faster than they anticipate, I think the Fed will be very quick to signal to markets that they're going to stop raising rates before they start to signal that they will start to decline rates. But that signal to the market that, hey, we've stopped raising interest rates. In fact, that last 0.5% or 0.25%, whatever it is that we were forecasting we would do in 2 months' time, we're not doing that. I think markets will take that news really positively, Ray, and I think it will actually cause quite a big upturn in markets again. So I'm not too concerned about them stopping, interest rate hikes. What I'm very concerned about is that they have to raise them for, more for longer because they can't control inflation. Sure. That's really the thing I would be focusing on.
Right, I've got a listener's question here for you, and I love throwing these at you. It says here, good day, sir or madam. We can call us sirs. My name is Lawrence. I'm a big fan of Warren's books. You've got a fan. I feel like they are the most understandable and executable pieces of financial advice I've come across. Thank you, Warren, for what you do. It's very nice. I'm a fan of Warren Buffett as well, and I know you are, Warren, and would like to invest in Berkshire Hathaway. I see I can buy equities on Easy Equities in dollars, which is not as affordable as the ETNs in rands. My questions are, what are ETNs and how do they compare with ETFs in terms of risks and attractiveness? And that's from Lawrence.
That's thanks, Lawrence. I really appreciate the compliment. It's nice to now have a fan. I appreciate that. Thank you. So very quickly, because I can talk about this for years, and I know we've got limited time. Firstly, just the difference between an exchange-traded fund, an ETF, and an exchange-traded note, ETN. So an exchange-traded fund is very similar to a unit trust, and that means that when you buy an exchange traded fund, you are buying. Let's say you buy an exchange traded fund on the Johannesburg Stock Exchange, where that represents the top 40 index. What you really are buying is physical assets. In other words, cash is going into a fund. That cash is being used to buy the top 40 shares on the JSE, the same 40 shares that are represented in the top 40 index. So you're actually a part owner of a physical portfolio of shares. So your risk in an exchange traded fund is simply stock market risk, whether those shares collectively go up or down or sideways, or do they pay dividends or don't they? But you've got very little other risk other than stock market risk. With an exchange traded note, it's rather a different beast. An exchange traded note is an investment that's issued by a bank. And what they do is the bank says, if you buy this note, we're going to give you the performance of the index. So your risk there is firstly the stock market risk. Will that index go up or down? But secondly, you're actually giving your money to the bank, and you're taking the risk that bank is still going to be around. In other words, you're taking the credit risk of the bank, because the bank's not going to go and physically buy those assets and hold them for you. They're going to go and use that money to buy derivatives and certain bonds and other instruments to give you the performance of that index. But if that bank goes bankrupt, you will lose the money of that exchange traded note. So people like exchange traded notes because they often are used to track, things like commodities or a rand dollar exchange rate or something. So it's a little bit harder for private investors to go and buy, a whole chunk of gold somewhere. So they like buying the ETN on that. But just remember, you do take the credit risk of the bank that issues those things to you. Is it better to buy Berkshire Hathaway or an ETN on Berkshire Hathaway? For me, I always prefer to own the physical share as opposed to the ETN. So personally, and I guess it is a personal choice, I would rather own my Berkshire Hathaway shares than an ETN on Berkshire Hathaway. Also because I get the benefit of an invitation to go and listen to Mr. Buffett and his partner Charlie Munger every year in Omaha if I'm a shareholder. Yeah. So I like that deal as well. So I would buy the Berkshire Hathaways is my short answer.
That really is really good sound advice. Warren Ingram, personal financial advisor and executive director at Galileo Capital. Good to chat to you once again on The Money Show. I'm sure I will chat to you again next Thursday.
Thanks so much, Ray. It's great to chat.